Hi, today is August 7th, 2020, and our special guest today on the Atlantis Report is George Gammon. George is a YouTuber, a podcaster, an investor, former real estate mogul, and all around great informer about what's happening financially in the markets, gold, silver, all kinds of real estate investments. Welcome, George, to the
Well,
Atlantis
thank you
Report.
for having me. Thank you for having me.
Great for you to be here. And you're in St. Bart's. I just want to let the subscribers know that. And let's start off today with talking about um, the fact that there's a current gold and silver and Bitcoin rally. Do you want to
Yeah.
just elaborate, please?
Well, I think if you look at the expansion of the base money supply and the broad money supply, it makes a lot of sense. And I know a lot of people going back to the last bull market would say, well, it should be a lot higher now, and maybe it should, maybe it shouldn't. But it definitely makes sense. And if you look at commodity trends, they go in these long cycles. Now, Bitcoin's a little bit different because we just don't have a lot of historical data on Bitcoin. I like Bitcoin as a speculation. I definitely don't think that it competes with gold or silver. It's a much different asset class. I really don't understand the people that really, um, put their feet in the ground and say, "Listen, I'm all about Bitcoin, or I'm all about gold. Gold is better. Bitcoin's better." And it doesn't make sense to me because I think they serve a much different role in my portfolio. One is just insurance. The other is a speculation because I think there's asymmetry there because you really can't tell if it's cheap or if it's expensive. It's tough the way I measure things. So, but I think it all makes sense if you look at what's happening not only from a standpoint of the monetary inflation, but if you also look at the social unrest, you look at the rioting, the looting. People want a safe haven, and you've
Right.
got a few competing safe havens, the dollar, and you've got treasuries. I think treasuries, although they may go higher, I think they're still in a massive bubble. I mean, when you're down around zero, or when you got 15 trillion in negative yielding bonds across the world, I don't see how that's not a bubble. And so then the last man standing, so to speak, is gold. And really, the knock on gold prior to this, as far as an asset class or a store of value, is that it had a negative carry. If you've got to store it somewhere, or maybe you got to pay a spread. But if especially if you're in Europe, and you're dealing with bonds that are negative yielding, well, you've got a negative carry right there. And what's
Right.
bizarre right now is people really, I don't think they're looking at bonds from a standpoint of yield. I think it's completely switched where people are looking at stocks from a standpoint of yield and they're looking at bonds for capital appreciation. And that's a bizarre, bizarre world. But that's a type of world where you want to own precious metals and Bitcoin, that's for sure.
Exactly. So obviously you like diversity in your sorry, you like diversity in your portfolio, right?
Yeah, I'd like to set up my portfolio in three categories. So, number one, you've got insurance, what we talked about. For me, that's just physical gold, usually about 10% of my portfolio. And I don't even worry about the price. People always ask me if gold is cheap or expensive. And I don't, that's really the only thing where I don't look at that metric because it doesn't matter to me. I'm buying it for a completely separate reason. And yeah, you want to,
Sorry.
that's okay.
Hey, baby boy. Hey, outside. Hey, bud. Exactly. Sorry about that.
That's
Sorry.
okay.
So continuing, you were saying that, like me, you don't look at the fiat price in PMs at the
Yeah,
moment.
exactly. Well, in gold and in silver, it's a little bit different. But in gold, I don't look at the price. Just if I get an extra, $100,000 from whatever, I just buy $10,000 worth of gold. That's how I look at it. So that's one part of your portfolio. The next part I consider investments. And how I would define that is it has to pay me to own it. So that would be a real estate, which is kind of my area of expertise. A rental property is a great example of that. Maybe a dividend paying stock if you can get it cheap. And there are quite a few cheap ones, but you just got to kind of get outside of the box and get outside of the United States a little bit. And then there's bonds, something that pays you to own it. That's the bottom line. And then the other side of the portfolio, the third component, which I like to allocate about 10%, would be speculation. So that's something I'm buying just because I think it's cheap and it's not paying me to own it, but I think there's some asymmetry there. So uranium would be a good example. That gold miners would be a good example, or Bitcoin would fall into that category as well. So that's kind of how I quote unquote diversify the portfolio. And then what I like to do in addition to that is diversify the political risk. So I like to have assets in different jurisdictions, especially real estate, because it's a lot less liquid. And then I like to diversify my political risk, or excuse me, my currency risk. So that really, and everyone has a different situation, so it's not investment advice. But what I do is I kind of pay attention to where the majority of my bills are. So if the majority of my expenses are denominated in dollars, well, then I'm going to want to have probably 60-70% dollar denominated cash flow coming in to cover those expenses. So I don't have a currency risk against my income versus the expenses. But if I'm in Colombia, as an example, where I was most of last year, they're denominated in peso. So I do own quite a few Colombian assets that bring in peso denominated or peso cash flow. So that takes care of those expenses. So then with my portfolio, I had about 50-50 USD, and then the other 50% for other currencies. So that's an individual preference, but that's the last way that I like to diversify the portfolio.
Wow. You must have an accountant, a very good accountant to take care of all this for you. It's a lot
Well,
of paperwork.
yeah, before I retired in 2012, and I was an entrepreneur for many years. And as an entrepreneur, you pretty much by default have to be good at accounting because you get in the weeds with QuickBooks so often when you're setting up a business and you're setting up the chart of accounts, and you can delegate that to an accountant, which eventually you should. But I found in business with legal and with accounting that you've got to know just as much as the accountants and the lawyers, or you're going to get screwed. You're going to have big problems. So unfortunately, I know a lot about accounting and quickly, a lot more than I'd like to.
Exactly. Exactly. Right. Well, a lot of our viewers might be a little bit more modestly means modest means. What would you suggest for them, especially the millennials that are somewhat maybe in university debt, or they've lost their jobs? Which would they start right now at a time like this? And are there
Well,
opportunities?
yeah, the millennials have a huge advantage from the standpoint they've grown up with cell phones. They've grown up with the internet, and I don't, want to sound like this old guy preaching to everybody, but when I grew up, we didn't have that stuff in the 1980s, and we didn't. It wasn't even on the radar. And so when I was a kid, you just really didn't have that automatic education. It wasn't just almost intuitive. So with the millennials, they've got more time than money, most likely, but that's an asset. That is definitely an asset. And so they have to recognize that. So what can you do? Well, nowadays it's so easy to start a business online. I mean, take it from me, someone who's had an online business right now. If you want to call it a business, it's more kind of a little fun project. But prior to 2012, I had quite a few businesses that were offline, your typical brick and mortar type of business. And let me tell you, from soup to nuts, it's so much easier to do things online. And the outlay of capital to make almost the same amount of money is just a fraction. So, as an example, the last business that I set up, or one of the last businesses, it took about $500,000 just to set it up. So that's your outlay, and you don't know if you're going to make a dollar. You could lose the whole entire thing. And it's not like you're buying an asset that you can resell that has value. That's your startup costs.
Wow.
So you take that and compare it to starting a blog or starting a YouTube channel or a podcast. I mean, you can do that with a fraction of the price, and you just have to deliver value to people out there. You build a community, same types of things that you do as an entrepreneur. You have to deliver value. And if
Right.
you're able to do that consistently and you stick with it, you're ambitious, you really pay attention to the metrics and the analytics, at a certain point, whether it's a Google search engine or a YouTube algorithm, it's gonna pick up what you're doing. And it's not easy. It's very, very difficult because it's tough to stay disciplined when you're working 12 hours on a video, let's say, for a YouTube channel, and it gets 20 views, which they
Wow.
will, which they will. It doesn't matter how good you are. When I first, I've had my YouTube channel for about a year, and the first 3 or 4 months, I was doing 5 whiteboard videos a week, which is just an insane amount of work. And they were literally getting 20 to 30 views per video. The same videos that now get 100,000 views, back then were getting not even 100. And but I knew from doing the homework and studying how that the YouTube algorithm worked. And we haven't discussed it, but I've got not an extensive, but a little bit of a background in blackjack and probabilities. So my mind, I've kind of trained it to work that way. So I knew that if I just stuck with it, keep your nose to the grindstone, don't worry about the views, don't let it get you down and out. Eventually, it's just a matter of time. It's not a matter of if, it's a matter of when. And but that's the big advantage that millennials have right now. And if you could just save up like 5 grand, so I mean, drive Uber, do something like that, you could start 5, maybe even 10 online businesses for that amount of money. Don't do them all at one time, but you stagger them and maybe do different niches that you really like. And if you throw 10 things up against a wall, one of them's going to stick. And if you can do that for 5 grand, and the one that sticks turns into a business that makes 100 grand, 200 grand a year, that's a huge, huge edge. And then what I suggest they do is take the money that they're making from the online business and parlay it into a triplex so they can house hack. So basically, you're living in one unit, and then you rent out the other 2 units, and the other 2 renters are paying your mortgage, your taxes, your insurance, and hopefully you've got a little bit of positive cash flow. Because if you look at everyone's, well, not everyone, but the majority of people's number one expense is their housing payment, whether that's rent or mortgage. So if you're someone that's 25 or 30 years old, and if you can take your mortgage payments or rent payments for the next 20 years, and instead of giving them to someone else, take them and invest them into a portfolio where you're getting even a 6 or 7% return. If you can do that with real estate, I mean, just go to a compound interest calculator and type that in. You're going to be rich by the time you're 50. You're not going to have to worry about Social Security. You're not going to have to worry about the government. Your freedom is going to be in your own hands. You're going to be the master of your destiny. And that's what I suggest every young person to do. And then, of course, going to have some precious metals, do those things, and watch channels like yours and Lynette's to really understand what's going on from a macro point. But I think that's where everyone can start.
Exactly. And that's obviously been the secret to your success. What you just advised is obviously real world experience, according to
Yeah, I've
George
done
Gammon,
both.
right?
I've done both. Most people, they've either been an online entrepreneur, so they really get like the digital marketing stuff, or they've been an offline entrepreneur. They own a McDonald's, they own a construction business or something like that. And they don't really get both sides, but I've had the opportunity to do both. So I can tell you the pros and cons. And the online stuff has a lot of pros. That's for sure.
Awesome. By the way, I want to tell the viewers that you have a kick-ass channel because you teach a lot and you make it fun and you have like the whiteboards and it's really cool. I really enjoy it and I get a lot out of it. So I want to tell people to go check out your channel and of course we'll put all your links on the bottom of the video.
Thank
Anyway,
you very
you're
much.
welcome. You talked recently on your channel about the global reset that the
Yeah.
World Economic Forum has been talking
Yeah.
about. Um, we know some of the good points that things will be revalued, and there's obviously some negatives. There's something I haven't heard anybody talk about, though. Will that reset have any impact on the world debt or no?
Oh my gosh, the debt would just go through the moon. I mean, it would go to the moon because what they're doing. And now this is assuming that this comes to fruition. Now, that's a whole other
Right.
topic, and I'm not going to go into their motives. That's another rabbit hole.
Of
But
course.
assuming that they could execute on their plan, you've got it's going to reduce productivity just massively. because they're taking a tops-down approach, which we know doesn't work. If you want to maximize productivity, it's got to be a free market. And people have to be able to make their own decisions and to pursue their own self-interest and the interests of their family, because as human beings, that's how we're hardwired. It's not that we're not altruistic, but we're always going to prioritize the needs of our family. And so what they're trying to do is they're trying to manipulate that, and they're trying to steer us as a society, as humanity, in a certain direction. And that only has one effect, and that's to reduce the amount of goods and services that are being produced on aggregate total. And if you do that, that means lower economic output. And lower economic output means fewer tax receipts. And the way that governments are going to make up that gap is they're going to deficit spend. So that means that if you think sovereign debt right now in the developed countries is high, just wait till they roll that out.
Oh
I
gosh.
mean, it could, the amount of debt monetization that would be required to pull that off. But we could go that direction. I just spoke with a good buddy of mine, Eric Townsend, who runs Macro Voices podcast. And Eric and I were going back and forth about how, the MMT might play out, because that is really, now I've got quite a bit of respect for the people like Kelton and Mosler, who, the pros who see this this theory. I understand where they're going with it. I disagree with them on quite a few areas, but obviously they're really smart people. But unfortunately, the politicians take what they say and completely just turn it into pretzel logic, very much like they did with Keynes.
Right.
So, once it gets into the hands of the politicians, basically what it's going to mean is we can spend as much money as we want. We don't have to worry about it. That's going to be their bottom line. So I think Eric really lays out a plan on how this may play out really well. And he thinks that initially, because inflation typically lags quite a bit, these politicians will spend, they'll deficit spend, they'll keep doing it, whether it's through stimulus checks, through UBI, helicopter money, quantitative easing for the people, whatever you want to call it. And we won't see inflation. And people will say, well, look at this. Look at all these Austrians. Look at these hard money people. Look at these gold people. Look at these fools that are over there telling us that we should have worried about inflation. They don't know what they're talking about. Inflation is dead. We never have to worry about this ever again. So let's print even more money. So you can see this starting, and then maybe after a year's time, we're giving everyone $2,000 a month, and all of the deficit hawks and everything. Oh, you got to worry about inflation. And then we don't see it to a certain degree. And everyone thinks, well, we never have to worry about it again. And then the $2,000 a month goes to $5,000 a month. And the government starts to increase infrastructure spending even more. So the deficits go from, I don't know what they are now, maybe 10% of GDP. Let's say they're going up to 20, 25% of GDP. All of a sudden, after 2 years or 3 years, whenever it hits, the inflation genie gets out of the bottle. And we know once that happens, you're not putting her back in. You're done. And then what's going to happen is we've created this powder keg of monetary expansion that now has velocity, and it's really got a stranglehold. And the only way that you can get that genie back in the bottle is pull a Paul Volcker, going back to the early 1980s, where he jacked rates to almost 20%. But the problem is it's going to bankrupt every single government in the world, or at least the developed economies. Because if you look at, I mean, the U.S. economy right now can barely withstand like 0% interest rates. I mean, think what would happen if we just got wild and raised interest rates like 2%, which is historically incredibly low. Or think what that would do to Japan if they just increased their overnight rate to 2% or 3%, or where it's been historically as a norm, like 5 or 6%. I mean, it would completely crush the economy.
Exactly.
So, yeah, so think about if you have to, now there's an argument say, well, if inflation's running hot, that still might not be a problem. But yeah, in order to keep inflation or to bring inflation back, you would have to have positive real rates. And so there's just no way an economy could deal with that. And you would have a situation that would be similar, if not worse, than what we've seen with COVID, because that's an example of when economic activity goes from X at 100% down to Y at, let's say, 75%. And the quarterly GDP goes down by 30, 40, 50%, and who knows what it'll be annualized. That's a good example of what might happen. And taking it back a step to the World Economic Forum, and if that came to fruition, kind of their game plan. I had a conversation with Jim Bianco, who's just absolutely fantastic. And I was talking to Jim, and Jim really put things into perspective. He said in the GFC in 2008, 2009, you saw the pain that was felt not only in the United States, but in most of the developed economies. That's when economic output went from 100% down to 94%. So we had a decrease in economic output by 6%. If you take it back to the Great Depression of the 1930s, economic output went down to 75%. So it went down by 25. Well, I mean, if you think what happened with COVID brought it down to 50%, to where we're opening back up in a lot of states just hoping to get to 75% of where we were prior, that means we're right in the Great Depression if the government wasn't sending out all these additional stimulus checks and unemployment and kind of propping up demand. So my point is, if we had sovereign debt triple, double, whatever what it was or what it is now in 2 years, and then you had to take interest rates up to 7% or 10%, whatever, to really tame inflation, oh my gosh, that would take economic output right back to 75%. But see, the problem there is the government can't spend money. See, right now, they can do these stimulus packages. The Fed can monetize the debt to kind of paper over the problem. But if your problem is inflation, you can't paper that out. You can't print money, or you're exacerbating the problem. So that would take economic output down to, call it 75%, but there'd be no way out. We'd have to finally take the medicine that, quite frankly, we should have taken back in 2000. And we've just been kicking the can down the road for the last 20 years.
Exactly. So since this can't continue on in perpetuity, yet if all the governments stop adding to the debt, we know that will cause a debt implosion. Which do you think will happen? I mean, how do you foresee the short timeline ahead of us throughout 2020? How will things transpire?
Yeah, I think what their game plan is to create inflation, because they've really got two options. They meaning the developed world governments that are so heavily indebted. You can just default on your debt, which that they don't want to do that. Or you can default through inflation, because you're paying it back with cheaper currency units that don't have the same purchasing power. So I would consider that a default as well. But if you look at what the debt did in the 1970s as an example, if they could somehow pull that off, and it's crazy that we're calling that a best case scenario, but that would actually be a best case scenario right now for the developed countries, is like a 1970s type of inflation, to really get the debt burden down to where it was much more manageable. So instead of being at 120% of GDP, you got Japan at 220, it's down, let's call it 50, 60%. Then of course the people holding the debt take a haircut. There's no free lunch. Someone's got to take a haircut. But
Exactly.
at least that gets us to a point. And if you could do it gradually over time, that's kind of Ray Dalio's, what does he call it, a beautiful deleveraging type
Right.
thing. It doesn't happen all at once. That would be horrific. But if they could just kind of land the plane smoothly and take it over maybe a decade, to where you're seeing like 10% inflation, and somehow manage that. The problem is, I don't think that's a high likelihood of coming to fruition, because you've got so much of a monetary base and broad money. They've created so much of it since 2008. It's 10 times worse than it was back in the 1970s. So to control it would be almost impossible. But the probability is above zero, so there's hope. There's hope. But I think that would be a best case scenario. So if that's their game plan, they've got to increase broad money. They've got to somehow increase velocity. They have to do that. And those are the two major components. I think there's other psychological components as well, but those are the two biggies. And they've got to try to somehow get banks lending, people borrowing. If they can pull that off, then I think they get the debt down, like we were saying. But the result for the average Joe and Jane that's out there is you're going to see consumer prices go up substantially. And a lot of deflationists say, no, that's not possible because we'd have a debt deleveraging and it just wouldn't work that way. And they like to tell you about how the banking system works and that they create all the money, and that if those loans are paid back, if we're not issuing loans at the same rate, then it's deflationary. I totally get that. But I think inflation, deflation is very nuanced. So you can have an asset price deflation while at the same time the prices of what you're buying at the grocery store go up every single week. And if you look at the 1970s, 72 to 74 was a bear market in stocks. It went down almost by 60%.
Right.
So you had that happening while at the same time, as we know, the CPI was going up significantly. So you can have all these cross currents happening, but I think unfortunately that's what we can expect. And again, there's no certainties; there are only probabilities. But my base case is you would see the stuff that we all buy on a day-to-day basis go up in price while incomes lag, unfortunately. So you're going to have a lot of a lot of pain there, and then maybe asset prices come down. Maybe not in nominal terms, but in real terms. I don't know how housing, as an example, in the United States, in a lot of these cyclical markets on the coast that are at all-time highs, even higher than they were in 2006 when you adjust for inflation. I don't see how they continue to go up if incomes aren't increasing as well. In real terms, I mean, you could take interest rates down, I guess, but mortgage rates are extremely low. And they could say, well, we could have negative mortgage rates like they have in Denmark or something like that. Maybe, but that's a whole different animal. Having negative interest rates in the United States is way, 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 way different than just having negative interest rates in Germany or Japan. Because we're the world reserve currency, there's a lot that goes into that. And it's not just as easy as taking it from 10 basis points down to negative 10 basis points. There's a lot of ramifications there and unintended consequences. So I don't know that you can take mortgage rates down any further. Maybe you can. I mean, I would have said that you can't take interest rates negative, and look where we are now.
Right.
So, but that's really your only kind of bull argument. And then you could say there's a lot of pent up demand, but yeah, but if people can't afford it, who cares how much demand there is? They can't afford the mortgage payment. And if you looked at the price to income ratios in a lot of these markets like Los Angeles, I just don't see how prices go up. And there's definitely not any asymmetry to the upside. There's asymmetry to the downside. And meaning there's, your downside is a lot greater than your upside over the next 2 or 3 years. And what's bizarre to me is how anyone would admit in 2006 we were in a housing bubble. But for some reason, the people now say that we're not in a housing bubble, although prices are just as high, if not higher, in
Right.
inflation adjusted terms. So if we're in a housing bubble, then how are we not in one now? I don't
Exactly.
know. That's a weird argument for me. But my point is that it also, too, I want to mention one more thing about housing. If you look at a historical chart going back to 1900 and you adjust it for inflation and the size of the home, you see that prices were pretty much flat from 1900 all the way to 2000. So then we had, of course, the early 2000s. Everyone knows what happened then. Prices go parabolic. But they really shot off their historic trend line. In 2012, they came all the way down. When we bottomed out in August of 2012, we actually bottomed out right on that historic trend line.
Really.
So Yeah, so if you look at that as kind of like a baseline price where we should be in a healthy market, that means our downside in markets like San Francisco or New York or Miami, maybe Phoenix, you've got like 50% downside in nominal terms. So
Wow.
do I think that prices are going to go down in those markets by 50%? Maybe not, but I do think that they'll go down in real terms by 50%, let's say over the next 10 or 15 years. And I remember I was having a conversation with my sister who lives in Dallas. And everyone knows, the economy, relatively speaking, in Dallas is pretty strong, or was prior to COVID. And she's like, "Yeah, I understand what you're saying, and in real terms they'll go down, but I don't know. I mean, so many people are moving here from California and this," and she was giving me all these reasons. And I said, "Listen, well, let's just think this through." So I took a calculator. We said, okay, if prices go down in the next 2 years by 5% per year, and these were rough numbers. I said, "Do you think that's realistic because of everything that's going on with COVID?" And she's like, "Well, yeah, I think 5% per year going down. I see that. I mean, that could potentially happen." I say, "Okay, and let's say that prices are flat for the next 3 years. So that takes us 5 years out." "Yeah, I kind of see that happening." And I said, "Let's say after that, prices increase by, I forgot what it was, like 2% per year." And she says, "Yeah, okay, that's realistic." I said, "Okay, now let's assume over the next 15 years we have inflation of," I said, "maybe like 5% or 7%." It was something like that. And she said, "Yeah, that's totally realistic." I said, "Look, that gets us to down 50% when you adjust
Wow.
for inflation. When you adjust for inflation. So nominal prices, you could see them stay flat or even go up, but that doesn't mean that you're gaining purchasing power. You could be losing 50%. That's my whole point. So how that plays out is anyone's guess, but that's why when people kind of go back and forth to this inflation deflation debate, they've
Stagflation
really
too.
got to get
Don't
to
forget
the weeds.
stagflation. Okay.
Yeah, or
Yeah.
stagflation. Yeah, they've really got to get in the weeds and ask themselves, well, what question am I actually trying to answer with what asset class, with what consumer product, or with the dollar relative to other currencies?
Very true. Which brings me just to one more quick question before give you the final word, and that is the whole king dollar scenario. It's the dollar is obviously overbought, oversold, overpriced, overvalued. Do you see the dollar collapsing or just slowly declining as gold and other asset prices incline?
Yeah, I think a slow decline is most realistic because if you look at how other countries have lost their world reserve status, it doesn't just bam happen overnight. Especially now with the way the system is set up and the whole entire infrastructure is set up around the dollar. So it's not that it's weird. It's not like the dollar is the world reserve currency. It's the dollar infrastructure is kind of like the world reserve currency. That's what's important. It's not
That's
just
interesting.
the little green pieces of paper.
Energy and yeah, banking.
Well, yeah, banking especially. Yeah, the euro dollar system and there's a lot that goes into it. So I think that's a tougher ship to turn 180 degrees than just going from green pieces of paper to purple pieces of paper or whatever it is. So that takes a long time, but it's possible. I mean, there's so many dollars in the world. I've had this conversation with Jeff Snyder, who's a good buddy, and he argues that there's a lot more dollars outside of the United States in the form of euro dollars than inside of the United States. So if you had the DXY come down, I think it's 92 handle, maybe 93 handle right now, and we saw it at 75, maybe in 2011, 12, right around there. But if it went down quickly to 75, like in 2 weeks, or then maybe went down to 50 for whatever reason, then you have all the foreigners that are holding dollars, And I mean, you could just put yourself in that position. If you had $10 million in your bank account and you were in Switzerland or you were in Colombia or Dubai, and you're like, whoa, what's going on with the dollar here? I need to get rid of these things fast. I need to either sell them and buy my own currency, or I need to buy some dollar denominated assets in the United States. So that floods the system with dollars, and there you could see a very rapid decline. But I don't know that it's likely. Also, the central bank, the Fed, really doesn't have any way to combat that, because typically you would combat that with FX reserves that you have of other currencies. But the Fed only has $40 billion of FX reserves, which, to put that into context, is the same amount of FX reserves that Colombia has, the country of Colombia. So, I mean, it's just, there's no way they could defend the currency if it got into that situation. And the only other thing they could do is jack interest rates. But we talked about how detrimental that would be, because they're at 26 trillion in debt, and it's not going down. It's going up at a very, very quick pace.
Oh man, it's pretty
So,
depressing.
yeah, it's a tough question, but to answer it quickly, I think it would take quite a while, but it could transition over the next 10, 15 years.
You know what, George, we're going to have you back on again because I didn't get to talk to you more about the velocity of money and possible bank failures on, on the short-term horizon.
Yeah,
And
yeah,
yeah, there's a lot. So maybe we can, talk, reconvene at a future date and we can get you back on.
sure.
Yeah. So, thank you so much for joining us on the Atlantis Report today. And stay well in these crazy times, both you and everybody watching. And we'll be back in touch soon.
Awesome. Thank you for having me.
Thank you so much, George Gammon. And again, the links will be underneath the video. So everybody check this dude out. He's awesome. Take care.